following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
And welcome back to Volatility Views, your weekly source for all things volatility. My name is Mark Longo from the optionsinsider.com, as well as the Options Insider Radio Network. And I am joined, as always, by none other than one Don Schlesinger, the major domo over there at the Volatility Exchange. Don, welcome back to the show.
Thank you. I think we'll have a good one today. We're going to take a few questions from our mailbag, try to answer listeners' questions, which is always fun for us. And can't be doing it in a better environment. Spring has sprung here in New York, and we're looking at a 70-degree day, if you can believe that.
That is absolutely insane. We've been having similar weather, perhaps not as good as you. We got up to the 60s the other day. We've been vacillating back and forth between about mid-20s and mid-60s. Sometimes on the same day, which is a little bit annoying when you want to leave your house and you don't know what to wear for the day, because in the morning it's about 25.
Temperature volatility, huh?
There we go. We should be trading those CME weather products over there and start slinging size on those instead, because there's some vol to be had in those these days. 40 handle swings on the weather in the same day. That's something I think you could trade in and out of pretty easily. Of course, we will also be joined a little bit later on by one Mark Sebastian from OptionPit.com. In fact, I think I hear him right now. Mr. Sebastian, welcome back to the show. Good timing,
sir. I told you
sir.
it was only going to be 2 minutes, so...
Yeah, sometimes with you, no. Sometimes with you, 2 minutes can be a wee bit more.
That's true. Fair enough. So what's going on, guys? How are you doing?
We're doing great. We were just discussing the volatility of weather and how there's some good trading to be had in our 40-handle swings we've been having lately here in Chicago in the same day.
Oh, yeah, no, it's crazy.
Are you loading up on those CME weather contracts right now? Doing some gamma scalping?
Yeah, no, the CME weather contracts, no.
I hope you've dumped all your snow futures. I know you were pretty long snow. I hope you've dumped all those by now.
Unbelievable. Yeah, no,
I'm not looking too good for those.
I bought a weather straddle, actually, believe it or not.
Oh, yes. So I'm sure that's...
I've been scalping snowballs.
You've been scalping like mad.
Mm-hmm.
All right. And with the team assembled, we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we dive deep into the week's worth of action from a volatility perspective, and we're recording a day early this week, so it's going to be a truncated week from our volatility viewpoint. As we're recording this on Thursday afternoon here, the good old VIX cash is a wee bit down, about 6%, trading around 1790 right now. So a little bit to the downside here in the VIX cash, but of course, it still is early. The day is young. We could go anywhere from here. Mr. Sebas, what have you been watching in this truncated week worth of volatility from a VIX perspective?
I think our long-term trend continues to be higher. You know, take a look. I mean, it took us 2 days to take back and more everything that we lost on that 20 handle day. And, you know, we're now above where we closed. and we're about now above that 20-point sell-off, and vol's lower than it was. There's a general downward trend in volatility and upward trend in the market, and until we see kind of loose monetary policy tighten up, or I don't know what, they're almost begging you to buy equities here. So, I mean,
just to clarify then for our listeners, then when you say upward, you're not talking vol perspective. You're talking broad
vol
market.
Down,
yeah, broad market.
SPX up.
Just to clarify,
that's what I'm looking at.
In case our listeners are running to lift offers right now and anything VIX related so they can scoop up some vol. No.
No.
We're going to sit here in this kind of malaise until maybe gradually drifting upward until even the announcement of the old iPad 3 / new iPad wasn't enough to boost the market to the upside. Then essentially we're just sitting here waiting for the next either big shock to the system or the next big turnaround.
It's not the iPad 3. It's called the new iPad. Your story's
How
great.
ridiculous is that, by the way?
New
iPad.
It just shows you that is the first chink in the armor, if you will, of what's about to happen with Apple.
Don, I don't know if you know this, but Mark and I have a running, ongoing bash Apple thing going on our other show, The Option Block. We're just carrying it over here a little bit to bring it.
How's that short been working out?
Yeah, not exactly too well. I can't say.
I'm not saying that Apple's going to zero, but what I'm saying is everybody says, it's going to be the first $1 trillion company sold to you, to quote Don Schlesinger.
Yeah, that's the new narrative right now is $1 trillion company. Everyone's focusing on that, and interesting enough. I was kind of actually hoping that, not to make this the Apple show, but I was actually kind of hoping they would actually knock down that iPad 2 a little bit to make it more competitive with some of the other offerings out there, and they did a little bit, but that seems to they still really are vulnerable on that low end from Kindle and things like that.
Where they're vulnerable is that they closed off. There's such a closed environment, and look at what happened. I mean, the first time Apple was a closed environment back in the 80s. Well, eventually someone figured out how to take the concept of the cloud, the concept of this, and turn it into an open environment, and that brought us Windows and Linux, and basically destroyed the Apple system.
The runaway success story that is the monkey of Linux. Oh, not the monkey, the penguin of Linux.
From a professional side.
Yeah,
Linux,
I understand.
Linux had some cool stuff. And Microsoft was very open to programmers, right?
Definitely.
Absolutely. Apple was not. So, I mean, this closed environment, and I read this in the Wall Street Journal, so
it's got to be true.
But it's something that I've always thought about is that Apple is such a closed environment. Android's somewhat open and has really given Apple problems. And somebody's going to come up with a very open environment, and it will put Apple back where it was.
Don, we've discussed this at length on our other shows. I don't think we've ever actually had an opportunity to let you opine on all things Apple, either from a volatility perspective or from an underlying perspective. I know you must. Everyone has a viewpoint on Apple these days. So why don't you give our listeners yours before we dive into the rest of our vol review here?
Well, it's being touted just about every way. You can't turn on CNBC without hearing Jim Cramer wax ecstatic and say this is probably the greatest company he's ever known in the history of the United States.
That alone is a reason to sell very aggressively.
It's just an incredible statement. And I'm not saying that he's right or he's wrong, but you know how the old wisdom goes, that when the whole world is buying and everybody is saying that this is the greatest thing since sliced bread, you've probably missed the boat and it's time to go the other way. So I don't spend a lot of time looking at single stock names, but this is the preeminent one in the world today. So everybody has to take a look at that. And I would probably tend to lean in the direction of you guys that, the old saying that when the shoe shine guy tells you it's time to buy stocks and everything, it's time to run for the doors and get out. Well, the whole world is seemingly on the same side for Apple.
Yeah,
so
it's funny.
It's the time to be cautious.
I've been using that indicator since Apple was at about 3.5, and yet I've been been proven wrong time and again so far.
Yeah, I know. That's incredible.
It's everyone and their mother loves it, and yet it continues to go up. It's not the Netscape phenomenon or everyone else where everyone piled in and it kind of just fell by the wayside. Everyone's piling in, and yet it continues to surprise people somehow and come up with new things. So interesting. We probably should have a whole Apple Vol show one of these days. We certainly could spend an hour talking about it, and I'm sure our listeners would eat it up. It's like the other thing. It's the other counterpoint to VIX. You put up anything Apple, and people just eat it up. But
you know the old saying, I think it's John Maynard Keynes, that the market can confound you for longer than you can remain solvent. So you got to be careful.
It's your old blackjack thing, right? You have to manage your stake sometimes, and aggressively shorting Apple has not exactly been a good stake management position.
That has not worked out well for you.
And Don, since we are talking about Apple, that's a perfect segue here to dive into some Nasdaq vol here. And I know you've been looking pretty deep into the tea leaves on Nasdaq and what to look forward to going forward. And I know we're kind of in this malaise here with S&P/VIX. We're seeing a similar malaise where no one's really aggressively hitting bids or lifting offers here in Nasdaq vol. We're kind of waiting for the next shoe to drop.
Mm-hmm. It's absolutely remarkable. I'm not saying it's unprecedented, but we started this conversation 2 weeks ago when I looked at the 21-day, moving average of historical volatility. I jot these down from week to week. It was 10.82. And then last week we had this discussion, and I said, if you take a look at this recent historical volatility, it's like the patient died. It's just flatline, and it was 10.79. Well, now another week has gone by, short 1 day, because we're recording a little bit early this week. And guess what? It's 10.81. It's just a remarkable, hundredths of decimal points here in terms of any kind of change in a historical moving average. And I had one thought that's worth pointing out to people. When you look at these moving averages or trailing, indexes, you need to be careful when you have a day like Tuesday, when all the markets moved considerably more than 1%, and when we had a really decent volatility day. You tend to think that, with the current level in the 10 handle, a day like that was sure to have increased the average. And we looked at it, and nothing happened at all. It's not because the day didn't have enough weight or enough juice, to do something. It's that you have to be careful with moving averages, because all they really are is add the current day and take out the 21 days away. So you need to be careful in saying what 1 day may or may not do to an average, because what you have to do is compare the day that you're talking about, in this case last Tuesday, to the day that it replaced, which was 21 days prior. And you got to look that up and see what it was. That day may have been just as volatile as Tuesday, or even more so, such that, the effect is actually to make it go in the other direction. You're just taking it off one end and sticking it on the other end, and then, averaging your 21 days. But people sometimes lose track of that when they're looking at moving averages, that whatever happens recently has to be compared to the day that's being taken out or that drops out of the average.
Yeah, well, Don, here's an interesting thing, and this is why you need to start paying attention to Apple with your new flagship product. What percentage of Apple movement is going to be involved in your flagship product? It's something like 15 to 20% of the product, right? And an interesting question for you: what would Nasdaq Vol be if you didn't have an Apple in there? It'd probably be 3.
Yeah, it'd be sub 2% somewhere around there.
Yeah.
Well, of course, when you have one particular name that constitutes a decent percentage, albeit not a majority, but 15% is a big number, then obviously that has a weighting not only on the price of the index itself, but the volatility as well. So that, in fact, might lead the way, especially with the new Apple volatility product, to some interesting trades in terms of spreads. And we're going to get to discussions of this this a little bit later on in the show, when we come out with our Nasdaq VolContract futures and when there will be options and perhaps exchange traded products as well, that could make for some interesting trades of having Apple volatility contracts and spreads against Nasdaq VolContract. So something that we'll revisit in the future.
Don, a little marketing tip for you guys when you launch the Nasdaq contracts. Forget about calling them Nasdaq. Just call them Apple Plus. And then you'll have a explosion of interest. You get Apple plus all the rest of this junk in the Nasdaq.
Don, actually, have you ever considered doing a realized vol contract on an individual equity?
Well, yes, absolutely. And of course, it's somewhere down the line because, as you guys know, this now will involve SEC regulators. And the minute you say that, it kind of sends a shudder down your spine because the SEC is notoriously slow to approve any kind of products, and you have to jump through a tremendous amount of regulatory hoops. But we actually have the trademark name of Vol Shares, which is a volatility contract on an individual equity name. And it's something that Bob Krause has been very keen on for a long time. And it's absolutely in our plans to launch such a product. But, you know, the date is obviously uncertain because this will then have equity as the underlying, which means that it's SEC rather than CFTC regulated, and that simply means that the approval period can drag on a bit.
Yeah, that means you're opening the door to a host of fun problems and issues that will take a long time to be sorted out. But we are looking forward to the launch of those Apple Plus products. And of course, lest we forget, we also like to dive into the world of currencies here on Vol Views. And Don, a little product known as the Euro may have been moving a wee bit over the past few weeks. So what's been going on in Euroland now that the Germans and the Greeks are at it once again?
Well, here's the interesting thing. We talked about this last week when the front month, and we have two expiring contracts tomorrow. We have the 1 vol, the 1 month realized volatility for March, and we have the quarterly. We have the 3 vol, which began for the January period, January, February, March, and will also be expiring. So the two in tandem have the rest of today and tomorrow to go. And you'll recall that last week I talked about this apparent discrepancy between a settlement price and the actual volatility that had been logged and what was left and the implication for the closing price with respect to the stub or the remaining volatility. Well, it's really kind of out of whack for these last couple of days. So I'm going to be interested to see how it plays out. But again, to explain to the listeners, we have this partial realized volatility. It's the volatility that's actually been calculated by the formula. And we have 24 days in the 1 month period and 61 days in the 3 month, and they're almost done. So we got 22 out of 24 or 59 out of 61 days in the bank, if you will, calculated volatility. And those numbers are 9.37 and 9.77 for the 1 month and the 3 month respectively. In the meantime, on a theoretical contract settlement price, we have 1041 for the 1 vol and 1016 for the 3 vol. And in order for them to settle there, we'd have to have 2 days worth of volatility today and tomorrow of greater than 18. Now, 18 volatility, if you do it on a daily basis, at square root of 252, you divide by about 16 or 15.9. That would imply for 18.3, and let's divide it by 15.9, that you would need like about a little bit more than 1%, 1.15% movement for each of the next 2 days. And if the euro is about $1.32 now, so I make that to be about a penny 0.52, about 1.5 cents. So in order for this contract settlement price to be justified, you'd have to have a penny and a half movement in the euro today and again tomorrow. Now, that doesn't mean that the price of the euro will change. It could go up 1.5 cents today and down 1.5 tomorrow and be unchanged, but that would create that kind of volatility. I doubt that it'll go 1.5 cents 2 days in a row and be 3 cents different by tomorrow afternoon. But still, it's a very big number. So all I'm saying is I'm going to stick with my prediction of last week that the settlement price for these contracts is going to be in the mid-9s, which is what I said last week, but you're not seeing it yet. So they're holding out to the bitter end that you could have this kind of volatility over the next 2 days, but I'm thinking probably not.
Don, an aggressive sold to you this week then for the Euro vol. So listen,
Don sold to you, Schlesinger, at it again.
Listeners, this is one of the times you probably want to be listening to the show live because you can get in on this and start selling some of those Euro vols. By the time this show goes out tomorrow, you'll have missed 1 day of those 2 days, but perhaps you can still get in on that final afternoon's worth of action before these things settle out, because I agree with you, Don. It doesn't look like Euro is going to be fulfilling that vol number anytime soon. All right, and that is going to do it for our volatility review for this week. And now we're going to dive into an extended mailbag segment.
Listener mail. Listeners write in.
Mail's in.
Mailbox.
All right, and welcome to our mailbag. I've been promising here on Vol Views to get you guys back into the show on a more regular basis going forward, and that's exactly what we're going to do this week. We have questions coming to us across the gamut of social media, Twitter, Facebook, email, what have you. I'm sure I probably have some weird IM pop-up questions on my phone somewhere too. We just have everyone writing in across the board. So we're going to start things off with a Twitter question here from someone who goes by the handle Demas or Demas. I'm not sure how exactly you pronounce that. That's the fun part of all these Twitter handles, is that learning how to pronounce these various things. And he writes in, will the new Nasdaq VolContracts be exclusive to the Nasdaq like the Euro VolContracts are to the CME, or will they be multi-listed? Vol Views for life. I like that last part. Sebastian, you should get that tattooed onto you. VV for life. What do you say? Right,
We have lifer.
right on your forehead. What do you think? You think the wife would approve of that? Well, actually, I'm going to take this one instead of Don because I actually have the inside scoop on this one. I was chatting with the rest of the Volex team at our big Options Insider 5-year extravaganza last week, and I was chatting with Bob Kraus and Charlie Barwis, the CEO and Mr. BizDev over there at Volex, about this exact topic. I was discussing with him whether or not these contracts were going to be locked to NASDAQ, because I know every exchange these days is really, really looking for that next proprietary product to go up against the VIX and the SPX and kind of make their own cash cow, or whether they would be multiply listed. Obviously, the latter is better for the user base. Markets get tighter. There's more competition. It's just a better offering all around. And surprisingly, they are going to be multiply listed. Bob confirmed they're going to be on the ISE and a number of other exchanges. And if you know anything about the ISE and their recent history, of course, they're the ones who forced the SPY options to be multiply listed. They're big fans of multi-listing contracts. So these products will be listed across a number of exchanges. I think will be very interesting for the end user, because now you'll have a much larger pool of liquidity to draw upon. You'll have much tighter spreads. And just definitely for this product, it's a much better thing than to be locked on, let's say, if NASDAQ forced you to be locked on OMX or Philly. That would definitely be a much less desirable scenario for the end user. So yeah, I'm happy to report, Mr. Demas, that these products will be listed across the board for your trading pleasure.
And you know what, Mark? The number may keep changing every day. I can't keep abreast of it, so that's a pretty good thing, as Bob and Charlie have more and more meetings. But the last time I checked, which was about a week ago, so don't hold me to it, we had something like 8 committed market making firms who are going to be there on day one making markets for the Nasdaq VolContract futures. So that's very promising.
Yeah, they were telling me the same thing. They were actually having a hard time keeping up with the number of liquidity providers who are raising their hands and saying, oh, us too, we want to trade these vol contracts, these Nasdaq products. I'd like to think that Vol Views played a small part in that, and at least spreading the awareness amongst this institutional professional audience that, hey, these new products are coming. So I'm glad to see that there has been a lot of uptake from that, because that, of course, is the catch-22 for any new product. You have to bring the liquidity to the table first. Otherwise, you can't bring in customers because the markets are so wide you can drive a truck through them, and if you have no customers, no liquidity providers want to come in. So it's usually the death spiral of any new product. So I'm glad to see that the Nasdaq vol contracts are already off and running from a liquidity perspective.
Is because every one of our listeners has signed on, committed to trading a one lot, so we're going to have at least a couple of thousand on that first day, right?
Yes, listeners, I want you to know that if you do email in or write into the show or Twitter in, that is a verbal contract to trade a one lot here when these products do launch. And thankfully, we do have a lot of listeners writing in saying they do want to do that, though. So I think there's a lot of interest in these products when they do launch. We'll take another quick one here from Twitter. This one comes in from UNC 1482. Maybe he's a University of North Carolina fan. Maybe he's a big fan of the year 1482. I don't know, but he wants.
That's his birthday.
Yeah,
January
exactly. We have an immortal vampire writing into the show here. He wants to know about the TVIX and what's going on in the land of TVIX. He writes, "What's your take on the ongoing TVIX drama? What's the cause? Was it shady? Is TVIX done? Thanks for the information." And of course, we discussed this a few shows back about the interesting explosion of assets that went into that TVIX ETF. Of course, TVIX is that double leveraged ETF linked off of the, or is it an ETN? I forget. But one of those two linked off of VIX. And we saw an explosion of assets go into that name over the final 2 weeks before it shut down. And almost 40% increase in assets over the past few weeks, until finally the TVIX folks said, you know what, we just can't handle this. We need to shut down new creations. And that, of course, led to the NAV of that fund, that NAV of that product, really disassociating from the actual value and getting bid up as more people were trying to pile in to that product. So, Mr. Seabass, have you been following the ongoing TVIX drama, and what is the latest over there on the TVIX front?
Yeah. Well, no, an interesting thing is that shortly after this whole TVIX thing came out, shockingly, ProShares came out with UVXY. Now, what is ProShares? That is the TVIX's, that's one of the major competitors with the iPath and with the Credit Suisse ones. So there's actually a TVIX2 in UVXY that is cleared up all of the backlog and demand in TVIX and actually helped loosen up the some of the TVIX problems. Now, TVIX is still hard to borrow, and it's still kind of screwy, but UVXY has definitely cleaned up some of that. Now, one of the interesting things that's being pointed out is that the ETNs now represent a incredible percentage of VIX futures. And so that's actually going to be something that they're going to have to start regulating. They're now big enough where they're really starting to move VIX futures and affect SPX skew and all sorts of crazy things. So the TVIX stuff is certainly has gotten better with UVXY, but there's still some unwinding that needs to happen of that weird hard to borrow thing. So,
and do you find the timing of that new product to be a wee bit coincidental?
I do find it to be a bit.
That they just happen to have that ready to go to push the button on that the same exact time frame that the other product imploded, or was it just they had something ready to go and they just, oh, this is perfect timing to launch this?
I don't know. Makes you wonder though. UVXY launched. And I mean, it's incredible. If you take a look at the way the volume numbers increased in UVXY, it's been around for a while. It's been listed since 10/27, but I guess so October. I guess nobody really knew it existed, and has been just super actively traded since the whole TVIX disaster.
Okay, so it wasn't a question of them pulling the trigger on a new product. This is people flocked to an alternative, and that was the best choice they had.
That's correct.
So it has been a good development for them. Whichever way it played out, it's been a great...
look at this on the volume on here. I'll give you this. All right, the volume on January 4th, 296,000 shares. The volume yesterday, 10 million.
That's incredible.
How about that for product growth?
There we go,
One man's misfortune is another man's bonanza.
There you go.
That's an interesting development.
Shady? Is TVIX done? TVIX is not done. Was it shady?
I think we'll leave it at that. That's a good response as any.
One of the things we learn in all markets and in all times is that sometimes you create a product and you really can't forecast what the response will be and what the size will be. And this may have been an instance where, the furnishers of the product just reached a point where they said, we can't take on this kind of risk. This has gotten out of all proportion. And we've got to do something before it potentially turns into a very serious problem for us. So yes, of course, you can look and say that there's something shady about it, but it's also just very possible. It's one of these things where nobody could foresee what the popularity would be. And if you're the issuer and you're on the other side, you reach a point where you just can't be comfortable anymore and managing that kind of a position.
Yeah, so, well, the interesting thing is the growth in shares outstanding and creation units that took place over like a 3-day period. And I guess basically Credit Suisse decided they did not want to be short 80 million Vega in the VIX anymore.
Yeah.
And that's fair enough. But do I think it was shady? Let's just say that. It's things that make you go,
Right.
Things that make you go, Things that make you go, is what I would say.
Well, with that lovely rendition of that actually is a 90s classic, sir. So that's a little bit out of your wheelhouse. You need to go back a little bit more for your true 80s references. But yes, it is certainly interesting, the spike of volume that flowed into TVIX right before it shut down, whether it is just coincidental or not. I don't know. You don't have to be a tinfoil hat wearer to see that that is at least coincidental volume. All right. And next up, we have an email question, actually from Ted down here in Austin, Texas. Lovely Austin, Texas. I'm sure they're gearing up for the big South by Southwest festival that is going on, I believe, this coming week. I've always wanted to go, but unfortunately there's a big derivatives industry conference that goes on that same week in Boca. So I've never been able to go, even though there's a huge interactive part of the festival down in Boston, in Austin. I'd love to check that out one of these days and see all the latest up and coming web startups and developments. But c'est la vie, our business pulls me elsewhere. But Ted writes in, hello, Mark, Don, Mark, and or guests. So I'm guessing he's listened to the show once or twice. He knows we have a few guests here, as well as good old Mark S. on a regular basis. He says, I'm new to the show, so I apologize if you guys have discussed this in earlier episodes, but I'm intrigued by the concept of vol contracts and how they work. Would the new Nasdaq products be normal futures and options in the truest sense? In other words, do normal strategies such as verticals, time spreads, etc. apply in your vol contracts products, or do I need to relearn my trading fundamentals and apply some new concepts to fully capitalize on these instruments? Thank you for your assistance, and thank you, Mark, for all of the wonderful shows on the Options Insider Radio Network. Good luck to Volex with the new product launch. Well, first off, thank you, Mr. Ted from Austin, for your wonderful words of encouragement, both to myself and the radio network, as well as to the folks over there at Volex. And Don, this question actually is very timely because it plays into something we've been looking to discuss again on the show for a while, because we've been getting a lot of feedback similar to this for the past few months, certainly ever since we started discussing the new vol contracts products on the Nasdaq. A lot of people, especially newcomers to the show, like our friend Ted here, are writing in to say, hey, what is the deal with these vol contracts? Are they standard products? Can I come in and trade, let's say, a vertical? Will it perform the same? Do I need to relearn my Greeks and relearn how these things perform? So this is the topic we've been looking to get back to for a while, kind of running through the basics of vol contracts as well as some strategies that are applicable for these products. So it seems like now is as good a time as any to get into this topic, Don. So why don't we dive in here?
Well, the fun answer is yes to all of the above. So, the vol contracts are futures contracts. They do have a multiplier, 1,000. They've got a price. If that price goes up 2 points, you own it. You make 2 points or 2,000. If it goes down and you're long, you lose it. So the mechanics are similar. The important thing to understand about all things volatility is that the underlying, which is volatility itself, volatility of Nasdaq, volatility of the euro, volatility of any commodity or precious metal, whatever we will create the contract on, volatility is a different animal from what traders, investors may be accustomed to. When we price options, we have a Black-Scholes or a black option pricing model. And part of the component of that model makes assumptions about the movement of the underlying. In the case of a stock, for example, we have a forward price. We have a growth rate for interest rate or risk-free rate. We have dividends that might apply to an index or to a single name stock. We can forecast a forward price for that underlying. And then we have a separate component that sometimes goes under the heading of random movement or Brownian motion, which is the volatility component. We may have a certain expectation for a forward price, but how are we going to get there? How is the underlying going to move or fluctuate or vary as it goes towards a particular price? Well, volatility is not your average underlying asset. And the reason for it is because it may be the only asset that you or I trade that has this quality of mean reversion, which certainly doesn't exist in the equity world as we know it. And we've talked about this in the past, but it's a very important part of trading vol contract futures, hopefully options on those futures, ETNs. And we've discussed this before. There is a mean or an average volatility for any underlying. If we take a look at the S&P, it might be around 16%. If we take a look at Nasdaq, it may be somewhat higher in the low 20s historically over time. And as we reach different periods and different trading environments, volatility changes and moves, and it gets stretched, and it can be spike and higher, or it can be, as we are now, rather depressed and lower. And so there is a tendency for volatility to do something that really doesn't exist with other tradable assets, and that is return or revert to its mean or its average historical price. And so if we're accustomed to a volatility of around 20%, and for whatever reason, political, economic, world events, whatever, volatility all of a sudden spikes up to 50% or so, we have a component that says that over a certain period of time, we ought to expect the underlying or the volatility to revert or return to historical or average levels. And that's a part of volatility trading that you have to get used to, whether you're trading options, whether you're trading futures, because it's something different, and you need to take it into account. Now, what do you do when volatility is 50 and its average is usually 20? Well, there's still going to be two-sided markets, even at 50, and that's the interesting part, because we have what seems to be a contradictory concept, and one that I've tried to explain with a weather analogy. We were talking about that before. And that is that at the same time that volatility has a longer-term tendency to revert or return to a mean or a historical average price, it also, in the near term, tends to persist or to cluster around levels that it is trading at the moment. So although we may have a 20 for a historical level. If we're at 50 now, nothing says that that 50 isn't going to stick around for a while, or even go to 55 or 60. But eventually, we know that it will not persist into the longer term, and that we'll see a return. If people try to make an analogy to that, I've used a weather analogy. Suppose that for 365 days a year, if you take the average high temperature for a location, it turns out to be 50 degrees all year long. Well, when the summertime rolls around and you're in July and August, our average high temperature may be 80 or more. And so when it is 80 or more, is anyone going to predict that it's going to go to 50 tomorrow or the next week? That wouldn't be terribly intelligent to do. And so we have those 80s persist for a while. But we know that eventually the fall is coming. And we know September and October are going to roll around. And we know we are going to revert to those 50 levels if we wait long enough. And so you can have the concept of long-term reversion to the mean, all the while having a local environment or a persistence or a clustering around a level that's very different from the mean. So it takes a little getting used to when you're trading volatility to understand these concepts. Now, having said all of that, all of the traditional strategies that you're accustomed to, whether you're an options trader and you do a vertical spread with two different strike prices, or you do a calendar or a horizontal spread, trading a near-term contract against a farther out contract, or you do ratios, or you do straddles, or you do butterflies, can be done with volatility contracts. Your underlying is simply the volatility of the asset whose options you are trading. And of course, if you're trading the futures contracts, which don't have that optionality component, but simply are linear instruments, and you're trading volatility and whether it will go up or down, there is still an awful lot of types of trades that may be interesting. And if we have a few more moments, I'll just introduce a couple of them briefly, and in the weeks to come, we'll speak about others, because as the Nasdaq VolContracts draw closer, we'd like to give some practical applications of how can you just get in there and make some money with some of these trades. So you may start, since I talked about it, with a mean reversion trade. You may just have one of those periods where volatility is stretched in one direction or another, and you feel that it's going to revert to a more historical level or an average price. Now, other people may feel the same way, and when you go to trade the contract, you may find that sentiment is already reflected in the price of the contract. So you're going to have to compare your forecast for what the ultimate level of volatility will be in terms of a realized number, and whether or not that's already priced into the contract, or whether your forecast is for a more extended type of movement. But that's one type of trade that you obviously can do. Since we have implied volatility products such as the VIX and VIX futures and VIX ETNs, we know, we've spoken about it at great length, that there is often a spread between implied volatility and realized. So if you have the VIX futures, which are implied volatility, if you have the vol contract futures, which are realized volatility, you will probably see a spread in price between the two. Well, that spread itself moves around a great deal. Historically, over long periods, the difference can be 4 or 5 points on average, actual percentage volatility points. But there are times when it's zero. There are times when implied actually dips below realized. And there are times, as we've seen recently, where you'll take a look at VIX futures in the 20s and realized volatility is in the 10 or the 9 handle. So a tremendous spread way above the historical average. You might do some sort of a trade to capture that trend, or to capture the prediction that traditional spread will return to, quote, more normal levels. So these are just a few ideas. There are many others, and we'll discuss them in weeks to come, of the types of trades that you might do. You might do intermarket spreads, the volatility of one asset compared to the other, where you look up historical levels and find one looks cheap and the other looks expensive, and you might buy one and sell the other one. You might do calendar spreads, thinking that near-term volatility will move more dramatically than farther. You might buy a near-term and sell a longer term and try to exploit that differential. So between futures types of trades and all the traditional options types of trades, there are a lot of ways to make money. And as I'm always fond of saying, all you have to be is right.
I like it. I like it, sir. So, yeah, looking forward to all those new strategies that the new Apple Plus products will allow us to trade, and the combinations thereof, and trading back and forth amongst those different products. That definitely opens up a whole world of possibilities, and I know myself as well as many of the listeners are looking forward to diving into those. So thank you for that question, Ted from Austin. And I think we have time for one more here in the old mailbag. This is a Facebook question. We're getting the whole social media gamut this week. And this one just comes from a guy who goes by Fred. I don't think we have his last name, or maybe he just didn't want it shared on the show. Either way, good old Fred from Facebook writes, "Hey, Vol Views crew. First off, love the show. I'm on board for a one lot whenever the Nasdaq products start trading. Heck, I'll trade one of each. Options, futures, etc. to bring them all on." So there you go, Don.
I'm going to hold you to that, Fred.
There you go. That's at least 3 or 4 one lots right there. So there we go. We're off to the races. As for my question, I hear you guys talking about the problems with using VIX as a proxy for SPX volatility. Poor settlement, too many masters affecting the VIX, etc., etc. So instead of using VIX, I'm thinking of getting a pure realized vol position using delta neutral ATM straddles in SPY. The contract size is smaller, so it's easier for me to trade as long as I make my hedges and adjustments accurately. This should be a vastly superior proxy for true S&P volatility. Am I correct, or am I nuts? Thanks again, and please keep doing vol views. I agree with the earlier listener that wrote in to say, I love your advanced approach to the topic. No one else is doing what you guys do. Keep it up. Well, thanks for that, Fred from Facebook. Try saying that 5 times fast. And yes, we do try to take that approach with the show, as I'm sure you appreciate, and many of our listeners have written in that say that they do appreciate that advanced approach we take to it, while still trying to make it approachable for people who are not as savvy in the world of volatility. And in terms of your question, you're certainly not nuts. You're perhaps a wee bit more optimistic than I am, but we certainly are. You're certainly not nuts. You know what you're talking about here with SPY straddles. It can get. I mean, depending on your terminology, you have that word pure that you're using there, and that's definitely a very loaded term. But you mentioned the fact that the VIX has many masters. That is indeed true. And if you do go out and get an SPY ATM straddle, that will give you a quote unquote purer measure of that vol. But then again, you have the downside of the fact that like you mentioned, you have to go out and hedge aggressively. You have to maintain those delta neutral hedges on a very regular, very active basis, and that is a downside for many people, having to do that on a regular basis. If you don't do that accurately, you're going to severely curtail your returns and the accuracy of the vol position you're creating there, which is a reason why so many people flock, or one of the reasons I should say, why so many people flock to these vol or VIX products, is that you do have essentially a product that will do a lot of that for you, even if, or give you that more approximate measure of S&P vol, even though it does take into account the skew, and even though it isn't exactly as accurate of a measure, but you don't have to go into and do all of those things you have to do when you're managing a delta neutral position, which is why so many people love to pile into the VIX and TVIX and everything else. So short answer, you're not nuts, but I think you have to be pretty savvy to really make that position pay off for you. Now, I'm sure Mr. Sebastian is champing at the bit to get in here at this question. So Mr. Seabass, what say you on this one?
Well, he's right in theory. The problem is that he's forgetting overnight risk. And I think that's the number one thing that he has to pay attention to. Take a look at Tuesday's movement. All right. There's no way you could the idea of capturing realized volatility assumes that you could constantly delta hedge perfectly all the time.
Exactly.
You can't do that. And especially because we have what we call overnight risk. We can wake up with the market down 30. We can wake up with SPY down 4. You cannot capture realized volatility that way. The only way to actually do that is with this vol contract that's coming out, or the VIX is actually going to do a better job of what you're trying to accomplish than trading a SPY straddle. That's just my opinion. And second off, don't ever just naked short a SPY straddle as a retail trader. Do a butterfly or something where you own some wings, because you would be shocked how quickly you can lose a lot of money being short straddles. Just a word of advice.
I would hope he's not just naked slinging straddles here. That he has some extra. Of course, he does just say straddles, so you're right. Taking him at his word, he could be just trading straddles. But
buy some teenies, my friend. Buy some teenies.
Teenies. You're dating yourself, sir.
I know.
Eights. Pick up some eights while you're at it.
I said that for Don. I wanted to keep
that
him.
was what we had. We had teenies. Anybody listening thinking that we're crazy, that was the designation for a 16th, as options with lower values, I think below $3, would trade in 16ths of a dollar back in the time when we had eighths and 16ths rather than nickels and pennies. Adding to everything that you've both said, and everything certainly correct and valid, once upon a time, before there were vol swaps, variance swaps, volatility products, volatility futures, delta neutral hedging at the money option straddles was the only way to try to capture the volatility of the underlying asset. I used to joke in my options conferences that you couldn't call up any exchange and say, listen, I'd like to buy a little volatility, please, because it wasn't for sale. The only thing that you could do was buy options and then hope or pray for volatility. Buy a straddle, buy a put, buy a call. Nowadays, all of that has changed, as we know, but the time-honored approach of trying to capture volatility by delta neutral hedging and at the money straddle has, number one, the cost of making those adjustments every day, transactions cost, bids, offers. And even if you did it a single time a day, you might be paying that bid offer spread for a month or 2 months or 3 months. There's an awful lot that's lost with that friction. Number two, Mark Sebastian's extremely important point, sitting there watching during the day, you might be able to defend yourself and make follow-up trades a little bit more frequently, but there is the overnight gap risk. And once that move has taken place and your straddle has moved and you need to make an adjustment, well, then, you're not capturing the continuous movement when you have jumps or when you have gaps. There are two others. They're more subtle, and people don't think of them all the time, but they're extremely important, and they get in the way of capturing pure volatility of the underlying by trading straddles. The first one is when you have one-way movement. So if you're delta neutral hedging, you start out with a 50 delta of a call and a put, and then you have one-way movement day after day, up or down, it doesn't matter. Those deltas change so dramatically that you can reach a point where the delta of one option is close to 100% and the delta of the other option is close to 0. Well, you don't have a traditional straddle anymore. What you have is a deep in the money option, which is practically behaving like a futures contract with linear movement, and you have a worthless option, which for all intents and purposes has no sensitivity to volatility whatsoever. And so you're no longer capturing the volatility of the underlying by trading this so-called straddle because you've lost the optionality or the option-like quality of those puts and calls. What you have to do before you reach that stage is you have to roll these contracts. You have to change the strike. You have to get more in line with at the money because you've strayed away from where you started from by such an extent that you lose the sensitivity to volatility. And that may have a cost to it as well. So you close out the old position, you take a new one, and if you're trading 4 different options there, that comes with a price also. finally, the most subtle of all is if you manage to navigate all of these waters and, come away fairly unscathed, there's still another problem that nobody can solve. And that is that trading a delta neutral straddle in order to capture volatility is what we call a path dependent event. How you get from point A to point B matters. And so I can tell you that we started the month and we ended the month and the volatility was 30%. But that doesn't tell you how you achieved the 30%. You might have been very volatile in the beginning of the month and not so much at the end. Or you might have been very volatile at the end of the month and not so much at the beginning. And you'd say, well, what's the difference? It's still 30 volatility. It's all the same. Well, it isn't. Because when you're delta neutral hedging, you have what we call the gamma of the options and how the price changes with movement of the underlying. And that gamma for at-the-money options doesn't stay the same over time. And so that gamma for an at-the-money option becomes more sensitive and larger closer to the expiration than at the beginning farther away. And that affects the manner in which you affect your hedges and how much the hedges may cost from one day to the other. Along with all the other caveats that we have in trading delta neutral straddles is this one of path dependency. And the bottom line or the takeaway from it is you can do everything perfectly. You can delta neutral hedge every day. You can roll your strikes and try to stay near at the money. You can hope that there aren't any jumps or any gaps. But the one thing over which you have no control whatsoever is the path that the underlying takes from beginning to end, from point A to point B. And that path actually matters and determines whether or not you'll be successful in capturing the actual realized volatility or whether or not you may actually make more money than you expected or perhaps less. There are many interesting papers that have been done on this topic. They've run, millions of Monte Carlo simulations where you take a period, you trade it, you delta neutral hedge it, and you just see how you turned out at the end. Sometimes you come very close to capturing the realized volatility of the underlying. Sometimes you do better. Sometimes you do appreciably worse. So it is somewhat of a crapshoot. And that's why something like a volatility contract that simply promises to deliver to you whatever the realized volatility was for the period and simply compare it to what you paid for it as a strike price is a very appealing concept because it eliminates all of these potential costs and aggravations, if you will, from having to trade delta neutral straddles every day.
Yeah, people always ask us why we're taking such a dim view of delta neutral trading on this show, and for all the reasons we all just outlined here, that's pretty much why we take a dim view of delta neutral. It's not to say it's completely useless. It's not to say it's inappropriate. I mean, it has its uses, but particularly for retail, I would say, particularly anyone under intermediate retail and even some of the advanced folks, it's a very difficult and time-consuming process, and you frequently, like you said, are still getting it wrong a significant amount of the time. So that's why there is so much interest on these a lot of these contracts that can at least take some of that work off the table for you and still deliver something that is of approximate value from a volatility perspective. All right, that is going to do it for the mailbag this week. Thanks to all of you who wrote in via our various ways of getting in touch with the show here. We love to feature your feedback on the show, and we're hoping to do more of that on a regular basis going forward. But now it's time to dive into our crystal ball segment.
And now we take a look at the crystal ball.
All right, and I love that little haunting melodic theme to kind of bring the show down a bit as we go in towards the end. And this is, of course, the crystal ball segment where we peer deep into the murky ether of the future and attempt to divine what the volatility gods hold in store for us for the coming trading week. And we're going to kick things off with S&P Vol, a.k.a. the old VIX. And Mr. Seabass, I have a feeling I know what you're going to say, but why don't we say it anyway?
Lower. Especially I think non-farms are going to be a non-event tomorrow. I think the VIX belongs in the 16s. Don't surprise if we get that in the next couple of days. S&Ps, like I said, I think the path of least resistance is up, not down. So that's where we're going to keep heading.
Thank you for that, Mr. Seabass. So load up on your VIX downside and trade accordingly. Do not buy that upside like we thought earlier. No, that was a joke. All right. Thank you for that, Mr. Seabass. And now, of course, we also like to dive into the world of Nasdaq Vol, or should I say Apple Plus Vol here on the show today. So, Don, I have a feeling I also know what you're going to say, but why don't we say it anyway for what the world holds in store for Apple Plus Vol going forward?
Well, this is an incredible period. We've been mentioning it before. It's unlike any that you're likely to see for a while. That is, so many days passing by with virtually no change in calculated volatility whatsoever. Once again, I would invite listeners to go over to the volex.us website. In the pull-down menu for data, just go to the Volex indices, bring up the whole array, and under equities, look for Nasdaq NDX, look for the S&P SPX, and right in the center of those charts, click on what looks like graphs or charts under that heading, and take a look. What you'll find is the normal fluctuating lines of 1 month or 3 month or 12-month volatility. As you get off to the present day, you just find this flat line. It's an incredible sight, if you will. And if you shorten the time horizon at the bottom to look at a whole year's worth of data, but to look at simply 1 month's worth of data, it's absolutely striking. You're not going to see graphs like this too often. Rather than try to describe it, just go ahead and do it. And what you're looking at is practically like the grid lines in the background of the charts, just a horizontal straight line with no movement whatsoever. And so trying to sit here and predict when that's going to change and when we're going to break out of this clustering, if you will, I think is pretty fruitless. I don't know how to do that. So will we have more of the same for another week? Are we finally going to move out of here? And if we do, to which direction? I'm going to take a pass on that because this is something that's really confounding everybody, and we'll just have to hang out and see what the next week brings.
A wee bit beyond our pay grade here on the old VolX show, the old Vol Views show. And, of course, everyone out there in NASDAQ and broad vol land is kind of waiting for the other shoe to drop. And when you have those unknown unknowns lurking out there, it really is relatively hard to predict what's going on. From a purely empirical sense, you can say, well, here's realized, here's implied. These two have to merge in some way, shape, or form. But we've seen a lot of that coming in now. And now it's just a question of when the next shoe will drop and which direction that will take us, or whether we're just going to hover here for the foreseeable future. A couple more months, we get into the May summer doldrums, and then it's anyone's guess how long we'll stay in this rut after that point. So we'll see. Interesting stuff to watch in the old NASDAQ vol land. Maybe it's time, Don. What do you say? Sell a bunch of ATM straddles and go away. What do you say?
I spent a lot of time doing that, so you won't get an argument from me. And it would have been good to have started a couple of weeks ago.
Yeah,
actually.
I think you kind of missed a lot of the boat here, but as long as you put some of those wings on, it wouldn't be too bad, like we discussed earlier. And of course, Don, we also like to talk about the land of the euro. We touched on it in the vol review that there is some interesting opportunities here to sell and perhaps sell again the euro vol going into these final few days of the contract here. Looks like a lot of opportunity to get in and try to capture some of that realized versus implied premium as it comes together. So Don, I have a feeling you're going to reiterate what we said in the vol review there and tell our listeners to sell with both hands the euro vol contract going into the final couple of days.
Long term, we'll take a look at the coming contracts, but we've got this immediate expiration before before us. So we've got the 1 month and the 3 month going out Friday afternoon. Our listeners may actually be listening at that time, or it's completed already as we record on Thursday. But we do have that phenomenon where the contract settlement price is intimating at volatility over the next 2 days, which certainly looks awfully high to me. So although settlement prices were 1041 and 1016 for the 1 and 3 month respectively, I'll go out on a rather easy limb this time and say that the final expiration prices for those two contracts are much more likely to be in the mid to upper nines than anything with the 10 handle. Any farther out than that, the April 1 month volatility contract or 3 months out to June, Vol Institute VLab predictions, courtesy of Professor Engel and his crew, are also looking at the low 10s, 1012, 1014, respectively. So possibility for average type of volatility historically for the euro going forward into the next quarter.
Don, taking the path of least resistance this week, but it looks like that may be the smart path to take given everything we're seeing unfolding right now, or should I say not exactly unfolding yet in the broad market. And of course, that's going to do it for this crystal ball segment. That's also going to do it for this episode of Volatility Views. I want to thank both of my cohorts, my partners in crime, for joining me on the show today. And starting off with you, Mr. Seabass of Option Pit fame. What is coming up in the land of the pit that may intrigue our volatility trading audience?
In conjunction with the CBOE and the Street.com, I am hosting a all-day webinar in New York on all-day live and over the web event trading the S&P 500. It's going to be S&P 500 options, S&P 500 futures options, futures, SPY options, VIX versus those. Once when we do this a year from now, we would probably be including the Nasdaq VolContract. It's a complete review of how to trade SPX options and futures. And actually, interestingly, I have an hour segment on how to trade delta neutral. So
we just won't mention all the things we discussed today. That's all.
Yeah, I mean, there's a lot of cool things, and it's $250 if you are a Option Pit member. It's $600, $595 if you are a non-member. If you sign up for my gold course, I will actually pay for you to go to this course. So I'll pay for your $600 to enter the this XPX event. So
sounds like a great deal, Mr. Seabass. For our listeners who want to get in on that action, by all means, surf on over to optionpit.com, and I'm assuming you can register there, correct? You don't have to go to the street or the SIBO?
No, you can just go to optionpit.com/events.
There you go, listeners. Line up for that deal. It's a once-in-a-lifetime opportunity to hear Mr. Sebastian wax poetic on the world of trading S&P.
And everybody knows that I'm good at trading the S&P, so it's worth listening.
All right, thank you for that, Mark. And of course, Don, we like to finish off every show with what's new, what's fun, what's interesting going on over at volex.us. So, Don, aside from the ongoing frenzy to get these Nasdaq contracts brought to an exchange near you in the near future, aside from that, what else is going on over at volex.us that may interest our listeners?
Well, I'm actually going to keep it right here, Mark, and tell our listeners of what I expect to be almost an unprecedented period of about a month and a half of shows that we have coming up. We have an unusually exciting array of guests, all of whom have been scheduled for the coming weeks. And I'll give you a very quick teaser and a very quick rundown of what's going on. But I think it's quite extraordinary, even for our show, where we have had guests on about half of the time. Next week, week, I'll be stepping aside, and Bob Kraus, our CEO, will be doing a show down at the FIA conference in Boca. And I'm a little bit envious if you take him out to the croquet fields again, Mark.
Yep, we're going right back to our old spot, Don, right next to the croquet courts.
1 year ago, we are celebrating our 1 year anniversary, and that should be a lot of fun to look forward to that. The following week, we have a gentleman by the name of Anthony Newberger from the UK. We met with him the other day, and he is actually the godfather, if you will, of the variance swap. Was the first person to come up with a formulation of using the whole spectrum of options and the entire volatility surface and coming up with the formulas for the variance swap. So he'll be a very interesting guest to speak to. The following Friday, the 30th, we have Peter Christopherson, formerly of McGill University, now at the University of Toronto. He is a very well-known and highly published academic who has written many, many papers on volatility, and he's agreed to come on the show and talk about some of his recent research. The following Friday, the 6th of April, we have David Palmer from Hudson Bay Capital. They do a great deal of in-house volatility trading and some proprietary strategies, so we look forward to his participation. The next week, the 13th, we actually have a Danish recent master's student who published an interesting master's thesis on alternative ways of calculating volatility. His name is Emil Stamp, and his paper caught my eye, and I think we'll have an interesting discussion with him, and I think a colleague that he may bring on. And then we'll skip a week, maybe just to catch our breath, and you'll want to mark this one down. I think that Mark gave us some statistics on what the most downloaded shows were in the 1 year history of Volatility Views, and I think leading the list was a show that we did with Ewan Sinclair of Bluefin Trading. And he is the author of 2 books on options and on volatility trading. He's got a 3rd book that's due out shortly. And back by popular demand, Ewan will grace the airwaves on the 27th of April and will make a return appearance. So this is a really exciting time for us on Volatility Views, and we hope you'll join us for as many of these shows as possible.
This is truly a very exciting time for us. I mean, the roster of guests we've been able to put together on this show is certainly unparalleled anywhere else in the audio spectrum, at least that I can think of. I don't know anyone else who's put together this roster of volatility guests, let alone the other topics and discussion points we get into the show. We get into on this show on a regular basis. It certainly has been a fantastic ride. It's hard to believe it's coming up on 1 year. And Don, we certainly will miss you at the croquet courts next week as Bob and I are sipping mojitos and waxing nostalgic upon the world of volatility in that nice tropical climate next week. But maybe we'll send you a photo so you can relive it with us.
Well, you have yourselves a good time, and I'll be back the following week.
All right. Thank you for that, Don. And that is going to do it for this episode of Volatility Views. I, of course, want to thank all of you out there for downloading and streaming and subscribing to this program. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about volcontracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.